What's up, guys? I'm Nobody Special, and we got another inflation headline today. And, well, just look at this headline, and it seems like CNBC is telling us there's nothing to worry about. Look at how softly worded this headline is. Wholesale prices jump 1% in July, matching June increase. Okay, that's not so bad. 1%. That's not a lot. And it only matched the June increase. It's not getting worse. Wrong. Wrong. This headline is weak sauce. Now, while what they're saying is true, wholesale prices did jump 1% in July. That is a month over month number. That's a 1% increase in a month. That's huge. And that does match the June increase, the 1.0% month over month that we got in June, but that was also huge. And another thing this headline isn't saying is that the year over year PPI jumped 7.8%. That is the largest increase in the history of the PPI. That is the largest inflation read ever for the producer price index. I don't see that in the headline. And that was more than the June number. The June number for year over year was 7.3%. And at the time, that was the largest increase in the history of the PPI. So that's 2 months in a row with the highest inflation read ever in the PPI. And once again, they're coming in higher than expectations. And I did a video about this last month. Month after month, these readings come in hotter than expected. So at what point are we going to expect hotter? When are we going to stop with these low expectations? Folks, inflation is here. Inflation is getting worse. We need to stop with this nonsense. We're making things worse on ourselves. Anyways, let's dive into the numbers a little bit here. It seems like services was the biggest contributor, in particular, final demand services. And final demand services it's not a very easy to nail down number. Let's just say wages is a big input to that. You're talking about retail, you're talking about cellular services, things like that, financial services, loan servicing. That's an input to this final demand services number, and that accounted for 1.1. That rose 1.1% in the month. So there was about 3/4 of the jump in PPI came from final demand services. They're also talking here that there was a hefty gain in margins for autos and auto parts, which jumped 11.2%. You could chalk that up to the rise in used car prices. And interestingly enough, the mention of auto parts, consider that with no new cars hitting the road, you've got the average age of a car in the United States is going up pretty fast right now. So I think you're going to see a lot more of this auto parts sales in the future. So that's something to keep an eye on. And also energy was a big input to this. Now energy, keep your eye on that energy number because there's some serious geopolitical risk built into energy right now. And it's not getting a lot of attention, but I think it deserves it. I did a couple of videos on the situation in Iran last week where a tanker ship was hijacked in the Strait of Hormuz. In the Strait of Hormuz, a quarter of the world's oil flows through that narrow strait. I think it's about 50 miles wide at its narrowest. And we still don't really know any information because the press totally swept it under the rug. But I don't know if they were hacked or if they were hit with a mine, but somehow the Iranians disabled several ships at the same time. They hijacked one of them and they started heading towards Iran. And the only reason the Iranians didn't seize it outright was because the crew somehow managed to sabotage the engines, and the USS Iwo Jima amphibious assault ship was steaming in their direction. So the hijackers wisely abandoned ship and headed back to Iran before a ship carrying 4,000 Marines and a bunch of helicopters bore down on them. And this came a week after there was an explosive drone attack on another tanker that killed 2 crew members. One was from the UK, the other, I believe, was Romanian. So there's been 2 military attacks on commerce in the Strait of Hormuz in the last couple of weeks. And I've been following a lot of these military feeds on Twitter, there's definitely been an uptick in military flights and military ships in the Strait of Hormuz. So there's a buildup of forces. There's an increase in tensions, and keep in mind the Iranians have a brand new president. He was just sworn in last week, and he's a serious hardliner, and he's got a bloody history. That guy. You've got the U.S. wants back into these nuclear talks, but the Iranians are not playing ball. The Iranians just opened this new oil export terminal that is east of the Strait of Hormuz. So if the Iranians were to shut down the strait, they can still sell their oil, which means they get all the benefits of the higher oil prices and pay none of the cost. And it would really hurt Saudi Arabia. And then I don't want to get into political waters here because we don't do that here, but you had Biden yesterday was on TV asking the Saudis to increase oil production. While at the same time, the U.S. seems eager to give away the energy independence that we've developed over the last 10 years because we're shutting down pipelines and we're not issuing new permits for oil and gas exploration. So we're vulnerable to energy prices right now. With the inflation story being what it is, a sudden violent jump in oil prices because of some kind of crisis in the Gulf right now would be catastrophic for inflation. And there's a lot of the ingredients are in place for a major oil crisis right now. Keep an eye on that. There's two other things I want to talk about in this inflation story that are worrisome. I used this chart in my video the other day. National rent growth. Now, this comes from Apartments List. This is not, to my knowledge, a scientific poll or anything like that. So take this with a grain of salt, but look at the trend and look at that steepening of the curve in rent prices in the United States right now. Now, this is average. This doesn't take into account regional issues and localized economies. So there's, the data is going to swing either way depending on where you look. But that is a big uptrend in rents. And that is going to be an input to inflation. Now, yesterday in the CPI number, the owner's equivalent rent only went up 0.2 or 0.3%, which is a joke. That is a joke. What a baloney statistic that owner's equivalent rent number is. I had one guy commented that he lives in his parents' basement and his rent went up more than that. So, and that's if people are even paying their rent right now. So you might as well raise your rent if nobody's paying it. Shoot. So that's something to keep an eye on. And another one is this one. Let me get my face out of the way here. This is global shipping container rates. Keep an eye on this number. Look at that. And now this is not just Shanghai to LA. All right. If you look in the upper left here, you've got LA to Shanghai, Shanghai to LA, New York to Rotterdam, Shanghai to Rotterdam, Shanghai to Genoa. Every single one of these numbers, or almost every single one of these shipping rates, has gone parabolic right now. The price of moving stuff is becoming untenable. This is the global supply chain grinding to a halt, is what we're watching in real time. And so this is going to have a major impact. I mean, think about all the crap on Walmart's shelves. It's all coming through one of these lines on this chart to get to you. And don't sit there and say, well, I shop at Target or I shop somewhere else. It's all coming from China, folks. And these charts, these graphs is going to jack up the price of every single one of those items on those shelves because it's all coming in a cargo container from China. All of it. So this number is going to filter down through the supply chain, and we're going to have bigger PPIs and bigger CPIs for months to come. I know the commodities have cooled off, and they needed to because they had risen so fast. And even these charts may cool off soon because these are not sustainable moves. But look, back in earlier 2021, we saw, prices went parabolic at the end of 2020, and then they came down a little bit, but then they resumed their parabolic move. And we're heading into the Christmas season right now, which means there's more stuff moving, not less. Right now, retailers are stocking up for their December inventory. And I don't think we're going to see the deals we're used to come Christmas time this year. Now, the last thing I want to talk about is this government stimulus that's coming. Now, they just passed $1 trillion in stimulus yesterday, and already there's another 3.5 on the way. That's $4.5 trillion in new spending. That money has to come from somewhere. The government has to borrow it from somewhere. Right now, most of the government's borrowing is from the Fed's printer. But the Fed has said they're going to stop the printer soon, or they're going to slow down the printer. How is the Fed going to slow down the printer at the same time the demand for that money is going way, way up? Well, if that happens, if the Fed does what they say they're going to do, and if the government does what they say they're going to do, interest rates are going to skyrocket. And I'm not even talking about rate hikes. I'm just talking about the natural supply and demand in the bond market. Because you're going to have a huge amount of bonds, a huge amount of supply hitting the market at the same time one of the biggest buyers, or the biggest buyer, the Fed, slows down their purchase. That means higher prices. So, I'm sorry, not higher prices. That means lower prices for the bonds. That means higher yields. That means, who is the government going to borrow from? Other central banks? There's a trend of de-dollarizing in these other central banks. So the idea that other countries are going to buy up our debt, I'm not so sure that's a safe assumption. Then you've got pension funds, mutual funds, hedge funds. Okay, they might buy some. Especially right now, there's a shortage of it with this reverse repo crisis. But there's not a $4.5 trillion shortage of it. So these financial institutions are going to demand more than 1.3% interest for their money in the face of these 7.8% PPI and 5.4% CPI reads. They're going to demand a higher interest rate. So those bond rates are going to go up. And that will be catastrophic for U.S. markets. That will be catastrophic for the jobs market. That will be catastrophic for stocks. I don't think the Fed is going to let that happen, because the government loses in that scenario, because the government has more debt than any other entity in the world. So why would the government allow the price of debt to go up? They won't. And that's why I think pay attention to what the Fed does and not what the Fed says. Because while the Fed says they're talking about tapering, with all of this new debt that's about to hit the bond market, the Fed is going to be forced to print way more and increase their bond purchases. I don't think it's the other way around. And it just comes down to who benefits. If you want to know which course they're going to take, who benefits? And the government benefits most from the destruction of the dollar, at least in the short term, and government is always about the short term. So, gold and silver are down today on this high PPI read, and, they're saying it's the market is pricing in rate hikes. Folks, I'm saying it, the rate hikes ain't happening. Short of some kind of financial miracle, I don't see the rate hikes happening. Anyways, guys, that's just my 2 cents. I hope you enjoyed this video. If you did, please give me a thumbs up, subscribe to my channel, hit that notification bell. It would really help me out. In the meantime, live small, dream big.